Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. I am back from vacation, in case you wondered what happened to me the past couple weeks. And today we're going to be analyzing Honeywell stock. This one came in by request down in the comments section of one of my other videos. If you have a request, put it down in the comments. I'll get it, the ticker on the whiteboard behind me. I've almost got those last couple columns checked off, and it looks like I have a lot of videos in front of me to make, but eventually I'll let you know that it's on the board and I'll make a video. Make sure to check out the Patreon links. I have a free tier over there. I've been posting more and more analyses over there, especially since I've been getting more requests. So if it's something that I don't think too many people are going to watch, or is just kind of a niche thing, or maybe I don't have very much to say about it, I might post the video over on the free tier on Patreon. And then I have weekly picks over on Patreon too for $25 a month. We had two of them today because I was gone last week, so a double weekly pick. So check that out over there as well. And then of course there's the full Cyclical Investors Club service always over on Seeking Alpha, and all those links are in the description. Okay. Honeywell, been around forever basically. Big industrial, U.S. industrial company. We're looking at over $100 billion market cap. So let's start by looking at the historical earnings cyclicality or patterns. We have a dip here during COVID, which makes sense. Now, during the Great Recession, earnings fell 24%. Let's zoom in back here. History is usually a good guide for what we can expect in the future. At least we should know what's possible because of what's happened in the past. And earnings fell about 25%. That's not super cyclical really, but what's interesting here to me is the stock price was much more so. Fell 61%. That's pretty much the same as the market actually, maybe just slightly deeper off the peak. So, but what's the valuation going in? That's with a 17 PE going into it. So those are all good context to keep in mind. So we can do a earnings valuation analysis on this because earnings aren't super cyclical as long as we take into account this downturn. And I'm going to use the COVID downturn as a proxy for any future recession. So because I think it was pretty similar, let's shorten the fast graph here. I do have a 25% off fast graph affiliate link down in the description if you want to check it out. They have free trials. So earnings only fell 13% here. But that at least, I'll bake that into the earnings growth estimate that I'm going to use here. So we can assume that there'll be some sort of, over the next 10 years or so, there'll be some sort of economic downturn at some point. Now, if we just go point to point on the fast graph, we get an earnings growth rate of 5.43%. That's right here during this time period. That doesn't really take into account this downturn. Also, they have bought back a decent amount of stock during this time, about 17% of the company over the past 10 years since a little before 2016. I take this into account usually when I'm doing earnings growth estimates, because if it's earnings per share like FastGraph uses, they'll be inflated if they reduce the share count over time. So it'll make the earnings per share growth will be higher than if they weren't buying back shares. So I want to know what it would be like. Like if I own this business, I want to know if I took those earnings and just spent them on something I wanted or needed, what would the earnings growth rate look like then, rather than taking those earnings and putting them and buying shares back in the company. Now, in general, I would say my earnings growth rate is going to be about 4.75%. Inflation during this time has been nearly that, at least since, well, if we just go going into the COVID downturn, right? The stock price has returned about 4.75% per year. That's basically the inflation rate during this time. There haven't really been any real returns from this business. Like that was total returns. What was the dividend yield? I wonder. 1.9. Okay, so it wasn't all dividend yield. So there really hasn't been much growth, honestly, for the company. I mean, they earned $8.16 in 2019, and this year they're looking at, we'll call it just roughly 10 since then. But we've had overall over 20% inflation since that time. So that's pretty close to basically what the inflation rate was. So they have been able to keep pace with inflation earnings wise, but they haven't grown at all really other than that. So I don't even think I have a buy price on this one in my official spreadsheet, just because that earnings growth rate's a little too slow for me. But it's not horrible. If the business got really cheap, like if the stock got really cheap, I don't know, if it sold off like 60%. Actually, I do think I have a buy price is like 60% lower. So if it got cheap enough, I would be tempted to come in and buy some, but it's just not anywhere close to that. Now what I'm going to do here is time until payback analysis. So this is an earnings and earnings growth based analysis. And what it does, what we want to know is how long it would take if you own this business and you paid $100 for it. Would it take it to earn $100 in earnings over time? So you pay $100. The earnings yield the first year is 4.17%. That means you would earn $4.17 on your $100 the first year. Well, how long would it take you to collect $100 if that was growing at 4.75% per year? Importantly, I have made I'll get to the importantly part. This is important too. I did adjust the stock price a little bit for their debt. I adjusted it up 16%. That's the difference between the market cap of $137 billion and the total enterprise value of $160 billion. So just a small adjustment there in case you were looking at it and you wondered, like if you look at the earnings yield here, it's 4.72% and mine is 4.17. So a little cheaper. That's because of the stock. I'm treating the stock prices as if it's higher. I'm also using the forward earnings from the fast graph of 1035. So I'm pulling those forward. So they could disappoint, right? There's all kinds of different things that could happen. So basically what we have here is a 4.17% earnings yield. So that means you'd earn $4.17 on your $100. And then that 417 is going to grow at 4.75% per year. Now, I had a question about this that came in while I was gone that I answered. Hopefully, it was just a one sentence answer, but this will explain it. And what they were asking is, shouldn't you be growing your $104.17 at 4%? And the answer is no, because that's the value of the business. I want to grow. I want to know what earnings are actually growing. So this is, if you own the business, the value of the business might change over time. It could go up or down. That's not really what we're measuring here. We're measuring how much earnings could you collect and then go do whatever you wanted to with them if you owned the business. Basically, that's the theory behind it, right? And this is a very simple version of it. So you could sell your stock, right? But this is not assuming anything is sold. You just own your business. Your business makes money and you keep the money. And then next year, the business makes even more money still, even though you may have taken your $4.17 per $100 and gone and spent it. You would still grow this amount in the next year. So that's what this is designed to do. So let's see here. So we start with 417 and I pull forward the first year's growth. So $4.36 the first year, you get to keep that. And then that grows to $4.57 the next year, you get to keep that. And then that grows in each year. So I want to know how long it would take to turn your $100 into $200 or to earn an extra $100. And it would take about 16 years before this crosses the $200 level. And so the thing here is, like, the S&P 500 is about a 15-year time. The lower, the better. You want to earn your money back, your investment back sooner rather than longer. So 10 years, when I'm getting ready to buy something, that's my kind of usual threshold. Sometimes I'll go a little higher if it's a growth stock that has a lot of long-term potential. Up to 12, 12 years is pretty much a hard cutoff. At 15, I mean, you start thinking about maybe this is something I want to sell, take some profits in, reduce, whatever. And we're at 16 on Honeywell. So to me, this looks expensive to me. Now, I saw some news that they were talking with Goldman about maybe breaking up or spinning off part of the company, the aerospace division. Strategically, that could be a good deal, I think, because if they can pull it off. For this reason, it's not a good deal for the owner necessarily. I mean, if you own the business and you split it in half, you usually have about the same amount of money coming in, right? In theory, sometimes maybe you can get an acquirer to come and buy part of the spinoff after you've done it. You could have more focused management. There are a lot of things they say, but here's my theory about what this is all about. One, they don't have any growth. Let's just call it. They don't have any real growth. So you have a mature business. It doesn't have any real growth. I don't know how big the spinoff is, but Honeywell is in the S&P 500, right? So all these people own it. They don't know that they own it really. They're just contributing to the 401ks or buying, an ETF or whatever. So they don't really understand like what's happening and what's going on. Now, Honeywell's big enough. If the spinoff's over, I would say if it's over 30 billion, probably it will automatically get included in the S&P 500 too. So now what you can do is you break the company up, or you have that spinoff go, and maybe you can sell it to these not discerning buyers at a very rich valuation, okay? And management and Goldman and everybody can make money. Traders can make money. You can try to anticipate this maybe perhaps if you're a trader. Buy the stock now, wait for the spin, wait for the price to go up, whatever, and then you can maybe potentially profit from it. We've seen GE do something like this pretty successfully. But the thing is, the company's big enough that if your spinoff and your leftover company are still in the S&P 500, from a trading standpoint, there's money to be made there for the traders and the managers and everybody else. The business, I don't think, is going to make any more money. So from a long-term perspective, it doesn't change my analysis any. But I thought I would point it out because, it could work. So if you think, well, Honeywell's expensive, I wouldn't buy it. But who knows? Maybe you can make 20% on a deal like that. And maybe it's relatively low risk too, compared to the market. So I'm more of an investor than a trader, but that's definitely, I don't think they're crazy for considering splitting it. We've seen a lot of worse companies do it successfully lately. Now, if the market rolls over and the economy sucks, then it probably won't work that well. But that's Goldman's job to figure out whether that's going to work or not. So yeah, they might be kind of pawning some stuff off on the public here, here pretty soon, and they're probably trying to figure out how to do that right now. It doesn't really interest me, but I thought I'd put it out there. So to me, this is expensive. If I owned it, I would probably wait to see if anything happens with the spinoff if I already owned it already, and maybe make a little cash and then cash out, right? Go find something that's growing. So that is kind of it's not anywhere near a buy though. Like it needs to fall 60% to really interest me. But if I already owned it, maybe you inherited it or something, I don't know. Maybe there's a little bit of sliver of light at the end of the tunnel. You might be able to do okay if they structure this potential deal well. Okay, hopefully you found this useful. If you did, hit the like and subscribe button. And if you have a request, put it down in the comments. I'm still slowly getting caught up on all the comments that came in while I was gone, but I'll eventually get back to everybody, and I'll see everybody later.